PowerPoint presentation. But in putting your questions, the number one issue with the reverse mortgage is all the misconception. People don't understand it. I use the word ignorance. I just trained 38 realtors last month around the country. I trained about 80 financial advisors in November of last year. And then today, hopefully we can get this thing through this. It's been 12:15 now, but it's the most misunderstood product. In fact, the first one I did, I think it was 2019, we still had attorneys in the room saying, do you still take away the house? Absolutely not. I'm not sure where they heard that from. We don't take away the house. The title still stays in your name or your revocable trust. As you know, you cannot lend on an irrevocable trust. Yeah. And for Medicaid planning, it could be an issue because Medicaid is not, it can't take an application if it's an irrevocable trust. There are some stipulations with that, how old the irrevocable trust is and how do you unravel that. So be very, very careful how you do that, because a lot of times somebody is pushing to get it out of the irrevocable trust, they might have a reason why. But in our industry, we have to be very, very careful with irrevocable trust. It is possible to do, but we have to be very careful. Let's see if the PowerPoint works. Okay, it works. So the reverse mortgage basically is a government loan for the most part, age of 62. We do have a limited resources for a jumbo loan or loans that don't qualify, fit in the FHA box, and we go down to 55 years old. But 98% of them, 99% of them are 62 and over, which is a FHA home equity conversion mortgage. If you hear that word acronym HECM, that's what HECM stands for. Basically, using part of your home equity to convert it to a mortgage. Okay. The big deal about this is there's no prepayment penalty. You can pay it back anytime, even every month. You go to Vegas, win some money, can pay it down. To keep the line of credit, which probably 99% of my clients use, you got to have at least $1 in the line of credit. And we'll talk about that a little bit later on. But if you do have questions, just put it in the chat, please. Common application of the reverse mortgage. I will tell you 40% of my clients have a mortgage payment. They can't live with a mortgage payment, or one spouse passes away and now they have less income to pay that mortgage payment, so they get a reverse mortgage. It increases cash flow. The reverse mortgage actually has a built-in annuity plan, similar to an annuity plan, where you can take monthly income for the rest of your life, guaranteed, or a term where you want a certain amount a month or certain years of the monthly income. More people take the home equity line of credit, and that's really to establish the home equity line of credit. 99% of my clients today use that. It's basically like a regular home equity line of credit, and you can take out at any time. You don't have to pay it back if you don't want to, but some people do if they're still working part-time. But it is the best thing of the reverse mortgage, and I'll talk about why it's the best thing about the reverse mortgage a little bit later on. Okay. You know, misconceptions, ignorance about the product is very common today. I've been doing it 23 years. It still happens almost every day, every week. It's not safe. You know, we hear bad things about it. I've had clients say, oh, my yard man said it's not a good thing to do. I said, what does your yard man know about financial world? He does not. But I've been doing this since 2002, and I'm not sure exactly when they started this, but the government is regulated by HUD since 1989 when we started. So there's a lot of safeguards in place. The main one is reverse mortgage counseling. Before anybody can start the reverse mortgage application, they have to talk to a third-party counselor that's not related to any bank or a title company or appraiser, anybody in real estate. They're normally a nonprofit, and they have to talk to the counselor. It's right about an hour, maybe a little bit more. This process was revamped about 8 years ago because through their research, they found borrowers that had dementia got through this counseling. And how they did it was the counseling process was only asking yes or no questions. Today, they ask you about 3 to 5 questions twice to make sure that you have a little bit of faculties left over. And you know your children's name, blah, blah, blah. It's a non-recourse loan. Non-recourse means only recourse they have the house. So in certain situations, very few times in Hawaii, but on the mainland, I've seen this where you get a mortgage, the value's here, and then like in the financial crisis, 2008, 2009, the market went upside down, right? I've seen houses go from 500,000 to 150 within a matter of 6 months. I had a client that had that. So when the mortgage balance goes higher than the appraised value, HUD comes in and says, listen, we're going to take over your mortgage. I had a client call me and said, don't worry about it. You're okay. It's a non-recourse. But the main thing is it can never foreclose upon you as long as you continue to pay your property tax and your homeowner insurance. And of course, all mortgages require upkeep of the property. And then lastly, you have to be owner occupant. So we document that every year. Do you still live there? That way, when the values went down in Arizona, Nevada, Florida, California, they were upside down where the mortgage balance was higher than the appraised value. They could still live there. And then when they finally pass away, you basically give the keys back to the lender, your family, and the lender will sell it. And the balance, the negative amount owed, is washed away. So they can never go after other property, your other heirs, or your bank accounts or your life insurance policy. It's non-recourse. It's a huge, huge benefit. That way they know they can stay home for the rest of life. I've done many where they want to be there for the rest of life, and they're comfortable, they're safe, they're happy, and the kids are happy. Monthly payments are optional. Like I said, if you want to take monthly income, you can take it for life or for a certain term or for a certain dollar amount. Okay. Spouse protections. This started, I don't know how many years ago, 8, 9 years ago, where if you qualify on a reverse mortgage basically off the younger person's age. So let's say I'm 75, my wife's 70. But I need more money than less money. So we're going to qualify you, and on title and on the mortgage documents, we're going to use a 75-year-old versus a 70-year-old. The 70-year-old gets less money than a 75-year-old. So unfortunately, they do have to take her off title and off the mortgage. But when the 75-year-old pass away, the remaining borrower on title on the living in the property, usually the wife, can stay there for the rest of her life, guaranteed as well, as long as no qualifying issues have changed. That's a new thing that started about 7, 8 years ago, and AARP helped push that, because in the old days, we would have to sell the property and the younger spouse had to move out or pay off the mortgage balance. So that was a critical thing that we saw happening, and it's a great thing. It's a little more specific. If you have questions about that, contact me directly. There's some stipulations regarding the spouse, younger spouse, staying in their home for the rest of your life. There's no prepayment penalty. You can sell or pay off the mortgage at any time. That's great, because people may not keep it forever, or they may move in with the kids, or they need to sell the property. There's no prepayment penalty. Adjustable rate caps. We have a 5% cap. So right now our rates are very similar to banks, 6.5%, 7%. So you add on 5 plus 7, what's that? 12. Where a lot of other mortgage companies and home equity lines around the country and in Hawaii is 18%. So somebody to really look at the fine print on this cap. That is a huge, huge issue, because if you're going to have it for the rest of your life, you want to be capped at a certain rate. So this is really big. It used to be 10%. We changed that many years ago. We added in a 5%. Okay, what am I? Okay. All right. The mechanics of a reverse mortgage, it works just like a traditional home equity line of credit. It's a variable rate. And it's a standard draw. You can take it whenever you want to take it out. It takes about 7 to 10 business days to get it wired to your bank account. And you're not required to make monthly payments. If you want to, you can. Sometimes we have the kids help pay back the interest every month. We do have you can take all the proceeds at any time. Here's a big thing for a tax guy, Mike. There's no issue with taxes. It's not income. It's just a mortgage. So it's tax-free money, which is very big for people that have large. In 2022, most of my clients were jumbo mortgages. We're taking out chunks of money to help the kids. So it's something to think about. We do have a fixed rate. It's pretty similar to regular rates around the country. But you have a fixed rate. The difference between a fixed rate and an adjustable rate, on a fixed rate, you take all the money out immediately. So unless you have a big mortgage that we got to pay off, we normally don't recommend that. Most people don't do that. You'd rather take the line of credit. It's more of like a liquidity issue. So like I said, the age, the market rate, the property value is how you qualify. And income is not necessarily a part of the criteria underwriting wise. It is to a certain extent, but it's a lot easier than qualifying for a regular mortgage. People call me all the time. If you want to call me, email me, text me, I can qualify you in a matter of minutes. Credit's not a real big issue. And we do pay out foreclosures. We do pay out bankruptcies. I'm getting a lot of calls for condominiums because the maintenance fees have gone up and they can't get the building qualified because all mortgages, we have to qualify the building. For FHA, VA, a little bit more stricter. So that's a big one today, what I'm seeing every day now. People are asking about that. Like I said, how much you borrow is based off of your age. So loan to value wise, if you're 62 years old, which is the youngest, about 31%. If you're 80 years old, when you get about 52%. I think the oldest age client I had was 97 years old. Yes. And guess what? 3 years later, when she turned 100, her financial advisor called me back up and said, can we get more money? And we did. You can actually refinance the reverse mortgage to get more money. The older you are, the more you're going to get. But of course, it depends on what the balance is. So all she wanted to do was increase her line of credit. And that's the big thing. If you think you'll live longer, you can refinance the reverse mortgage as long as you're older, so you get more money. Hopefully you didn't spend all the money, and hopefully the rates are still the same. And most times in Hawaii, the property values have gone up. I've seen it go up double in 10, 15 years. Maybe not now, but during the boom, it was going up. So I mentioned that the best benefit of the reverse mortgage is the line of credit. When I first saw the line of credit doing a couple of proposals, we give you an amortization schedule showing you what the balance will be 5, 10 years, up into 100 years old, what the balance will be if you took out money. And we also have a line of credit amortization slide column, which shows the line of credit going up every month, every year. So especially for financial people, CPAs, they want to see that because we can project out up until 100 years old what the balance may be down the road, but also line of credit is going to be. And the line of credit growth factor is based off of the interest rate plus 0.5%. All these loans have a 0.5% add-on every month for FHA mortgage insurance. So let's say if you're at 7% today, your line of credit growth rate is going to be 7.5%. When I first started in 2002, when I saw that, why would we want to give more money to them? And why would we take on more risk? So I called my manager in the mainland and said, what is this? Because it's a growth factor. Why do we do this? He said, when they started talking about this in the late 60s, they knew life expectancy was going to get higher. They knew the cost of living was going to higher. So it's actually, we kind of describe it as an inflation factor. If you live 10, 20 more years, right, you're going to need more money down the road. And so depending on your income, depending on your stock portfolio, depending on your value of the home goes up, how are you going to be able to do that? Well, if you set up the line of credit today, it grows every month, every year, there's nothing to do with the appraised value. It goes up automatically by the interest rate plus 0.5%. So I've seen line of credit grow double in about 12 to 13 years if you keep it there. I mean, historically. So obviously we don't know what the rate's going to be down the road, but it has nothing to do with appraised value when we close a loan. Automatic, whatever's in there increases by the interest rate plus 0.5%. If you look at this on an amortization schedule, it'll blow your mind. I did a financial advisors in November last year. They go, wow, we never saw that before. And people go online and study the reverse mortgage, but it's really hard to go online and understand really how it works. It took me about 6 months myself after 17 years of mortgage experience, knowledge. But it's a whole nother world. I've trained a lot of mortgage people, regular mortgage guys, we call them forward mortgage guys, and they have a hard time understanding the concept of the reverse mortgage. And this is really great. When people see this, especially today when we know kind of uncertainty with the government, uncertainty with our income, Social Security, our pensions. When one spouse passes away, we're worried about what kind of income they're going to have left over. Really important. So here's the variable rate. We show a graph every time you apply. We use a 4% appreciation. If it's $500,000, appreciated at $500,000. This shows you where long-term what's going to look like, right? So the value in 20 years from now will be here, and let's say you take a draw of 100,000. So this kind of shows you over time, when the interest that you're not paying every month is added to the balance, what's going to happen over time. And it shows you basically, you're kind of riding that wave of home equity appreciation and the mortgage balance going up, because all the reverse mortgage is a deferred interest loan. It's a negative amortization. So if you don't pay the interest payments every month, it adds to the balance. So slowly, by little, it goes up. So people don't factor in that the value will go up as well. Very important to understand that. I always tell people that, if you live to be 90 years old, which is a very good chance, you're relatively healthy, you live 90. Your kids have to wait till 90 to get any assets, any heirs, any money, right? And then how old will they be? 60? So I always tell people, maybe you want to ask your children, do you want the money now or later? And it's something that we try to help them out. As a fiduciary myself, we just try to give information to make the better decision on himself. Everybody's situation is different, right? So this just shows you what happens when appreciation goes up. It's the real world. What happens? So the line of credit grew $210,000. So this is the line of credit here. Here's our property value the last 20 years. The line of credit outdid the line of credit, or is right here, is very close. So you always have that line of credit for the rest of life. It can never be taken away. If you apply for a bank or credit union, you got to qualify. If you took out a $300,000 line of credit, you have to qualify the whole amount. And then when one spouse passed away, when they find out, they also recast that and we'll look at it again. So be very careful when you take out a line of credit today and you have about $200 or $300 down the road. How is it going to affect your financial situation, let alone pay for long-term care? So like I said, the income you can take, so we have a pool of money there. Let's say you have a pool of $400,000. You can take that in a line of credit, pay off your mortgage, or you can take payments per month. We call it term payments, 10-year payments versus term payment. 10 years for the rest of your life. So if you're a couple, when one spouse passes away, the remaining spouse still gets that monthly income guaranteed to them. Or you can take a term payment. Let's say you only need for 10 months or 5 months, or you want $3,000 or $5,000 a month. So we just work backward for that bucket of money. How long is that going to last? One of the major reasons why people take the line of credit is that the line of credit grows every year. If we have to give you monthly payments, we're going to lock that line of credit up. So there's no growth rate. So it's important to figure out what's going to happen down the road, or guesstimate what's going to happen down the road. In the old days, when I started in 2002, everybody that refinanced had a reverse mortgage with monthly payments, but they wanted to refinance because when they did it in the 90s, $2,000 wasn't enough monthly income. So this shows you your 10-year payments, and then of course, with the property value going up, so you're always going to have equity left over. That's why people don't, the fallacy is that when you pass away, we get the house. No, we don't give you more than 52% of the value, because we have to have a cushion over time. It's a term payment. Client scenario, okay. All right. So they have $148,000 mortgage. Home value is $500,000. So they got it. In this case, they had a line of credit of $289,000, paid off the mortgage. Mortgage $148,000. So the line of credit remaining equity is $289,000. So pay off the mortgage, and you have a line of credit there. So they're living without a mortgage payment, pay off the $148,000, and it's just they're living their life without a mortgage payment. And so this is the remaining equity here that people are gonna think about if they want to refinance again, or if they sell the house. That's how much equity is going to be left over. So cash flow comparison, like I said, current situation, they're making a mortgage payment on a $148,000. Mortgage payment was $1,900. And then you pay off the mortgage, you have no mortgage payment. And then you still have the line of credit here after you pay off the mortgage, no mortgage payment. And then they still got to pay the tax and insurance. So they have no mortgage payment, but they still have a $44,000 line of credit. So it gives them liquidity. Some people call me the ATM machine because I provide liquidity to their parents. Because I will tell you about 50% today, the kids refer them to me. Because they know mom and dad is struggling. We can't help them out. And I talked to Desmond and Scott, my brother, but we can't help them out. So we want mom to stay in the home for the rest of life, a guarantee. And we haven't even talked about long-term care yet or caregiving. Here's somebody here who's 79 and 75. So their line of credit, so we pay off the mortgage, $48,000 mortgage, how much equity they have left over. And they have a $210,000 line of credit growing every month. And and then they wanted also a 10-year term of $1,600. So these kind of scenarios, everybody's different. So I'm not going to go a whole lot over it. If you have a specific situation, we can go over in your situation. So I do want to leave some time for questions, okay? Cash flow, let's see how that important is that one. Not that important. Closing costs for the reverse mortgage. Our fees are just like a regular mortgage, except the mortgage insurance. What's called IMIP, initial mortgage insurance, that goes directly to HUD, FHA. It's 2% of their property value, capped at I think FHA goes up to like 1.1 million. It's 2% of their property value. And then the origination fee is anywhere from 2,500 to 6,000. Capped at 6,000, by the way. So that's kind of a good thing for them. Oh, anyway, yes. I did want to go over. I sent you the old one. Any questions?
Let me see in the chat.
Why don't you add in some questions? We got some time here. I went over it kind of quick. So a lot of people say they didn't get the PowerPoint.
Yeah, I can actually put that
Okay.
file inside.
All right.
Make sure I see it.
Okay. Then what was the questions over this? Something, right?
Oh, this was from earlier.
Okay. So the question was, what's the difference or disadvantage or benefits of a home equity line versus a reverse mortgage home equity line? So home equity line, you're going to qualify income-wise. So if you want a $300,000 line of credit, the bank credit union is going to qualify you as if you use the whole $300,000 line of credit, and you're going to qualify income-wise and also credit-wise. I believe your credit's got to be about 700, but don't quote me on that. The home equity line for the reverse mortgage is very easy to qualify, based off the age of the youngest borrower, home equity appraised value, and the current interest rates. Like I said, interest rates are pretty close to what they are today in the banks and credit unions. But we qualify you based off of residual income. So all we want to do is be able to pay, you have enough income to pay off the property tax and insurance every month. That's pretty much it. We do have a little residual income for living, but we can get around that. Today, about 7-8 years ago, we started including the property tax and insurance. So some people, they have dementia, some people are getting older, they're not so good financial savvy, or they have past credit history. As long as you have enough home equity, we will set aside money to pay the property tax and the homeowner insurance for them. So it guarantees it'll be paid they won't be foreclosed upon. So to me, it's a big issue down the road. So I deal with clients specifically over 55, 62 years old. I think my average client's about 70 years old today. It used to be 75, 80 in the old days. But in the last 10 years, we've seen a lot of younger people coming in looking at the reverse mortgage because financial tragedy after the 2008, 2009 financial crisis, they're paying for long-term care. The home value has gone up, and they have all the equity left over, and they can't qualify for a regular mortgage. And that's one of the key things I've seen quite a bit, because they can't qualify, or the credit's shot, or they have a big mortgage payment, and because they use that to pay for the kids' college, pay for medical bills, so all kind of reasons why. So when I counsel families, we walk in with a scenario of looking at both home equity line or the reverse mortgage home equity line? But that's a good question. Do I see a lot of borrowers taking monthly payments? Okay, so in the old days, like 10 years ago, unfortunately, many loan officers were telling people to take the money in lump sum, which is probably the worst thing you can do if you don't need the money. What happens if you take lump sum, all 400,000 or 500,000, and start collecting interest immediately? When you take that big of an amount, like I said, when the line of credit doubles in 10, 12, 13 years, so does the loan balance. So very rarely do we see lump sum, very, very rarely, unless there's a big mortgage we got to pay off. Monthly draws, we don't see as much as well, because if you can get $2,000, $3,000 a month, that's not really a lot to live on down the road, especially with inflation. So we can give you a spreadsheet showing your monthly income versus the line of credit. The line of credit compounds and grows the same as a mortgage balance. So when people see the line of credit in an amortization schedule, it's a huge, huge benefit by taking the line of credit. Monthly income, if they want to take monthly income, I tell them draw every month out, 500,000, whatever they need every month, only whenever they need it. Because the line of credit sits there without being charged any interest. That's really important, because when they see that, you get a monthly statement, they'll see the outstanding loan balance and the interest charged every month. Like I said, there's a 0.5% mortgage insurance as well annually. So they can decide on that. But a draw option is the best way most people do it. 5,000 here, 10,000 here. I have a lady going to Vegas end of June. She said, take it out now. I've had many people take money out to send them family on a cruise, buy a car for their kids. A lot of people are driving older cars, so they're buying new cars. But like I said, for the most part, in my personal experience, my clients, 60 to 70% of them, people are taking out the line of credit to pay for long-term care down the road. I can't remember exactly the statistic is, but I think 90% of people don't have long-term care insurance. My personal experience, 90% of financial advisors don't sell a lot of long-term care insurance. They don't. And it is, I think everybody needs to have that line of credit. Is 60% withdrawal for the first year mandatory? No, that's the max you can take out, by the way. So it's not a minimum, it's the maximum. I recommend people don't take out money if they don't need it. Just set it up and watch it over time. And then, because something's going to happen. We don't live perfect lives, right, Ed? Something's going to happen. We're going to get a car accident, we need to travel, we got to fix the roof, our increasing hurricane insurance is going up, our investment property not being rented out for 6 months for whatever reason. We have that line of credit sitting there, tax-free money to take out at any time. So the age limit goes down to 55. That's a proprietary jumbo loan. We use that for people that are 55 and over. They want to live in a home for the rest of their life. And same thing, fixed rate, take out all the money out, or set up a line of credit. So I've done about 5 in the last 2 years where they know they want to stay in home for the rest of their life. And they know that when I pass away, my wife can still live here at the property for the rest of her life. The proprietary loan, we do use it for condominiums and townhouses, because qualifying for FHA, VA for condominium is going to be a little tricky. And so if they can't qualify for the FHA, VA way, we go on a jumbo way. It's a little bit easier to qualify, but that's major reason why it's 55 and over. So if you think you love your property, you want to get rid of your mortgage payment, it does work. It does work. So the law will reverse mortgage loan to value. So loan to value, like I said, is 62. You're looking at 32%. At 80 to 90 years old, you're looking at close to 50% loan to value. And that's in a line of credit. So if you have $1 million property, if you're 90 years old, you can get a $500,000 line of credit. And it sits there without being charged interest until you take the money out. So people worry about when I die. So first thing I say, well, how's your health? Because before you die, you're going to need some form of care. And if you have memory care, it's $10,000 to $14,000 a month. If you need skilled care, it's about $12,000 a month. Intermediate level and all these places, anywhere from $5,000 to $8,000 a month. So it's one thing to realize that how that the ratio works and how the funds are used. With the proprietary, the sort of Leilani, you must know something in the business because that's a good question. The proprietary jumbo loan only appreciates, I believe, 1.5% fixed. It's not like the FHA VA loan or FHA reverse mortgage where it's increasing by the interest rate plus 0.5%. That's a good question. It does grow. It gives you actually, the jumbo loan gives you a little bit less money. There are higher rates, obviously, because it's a jumbo, but it's a good question. So something that when I train attorneys and financial advisors and CPAs, they got to understand the differences. And so we weigh their long-term needs. When we counsel families and attorneys and CPAs, we walk in with a blank piece of paper, find out what's going on with their life, and then we make a decision. Because too many times we're seeing people put their own opinions about what the reverse mortgage is good or not for them. I've been in cases with divorces where we use a divorce because we have to pay off one of the spouses, so we use the reverse mortgage to pay them off. We're seeing situations where dad's house, family house, but he has kids, and dad's wife of 20 years has kids as well. So, but he's only on title. So you got to be careful because when he passes away, she may or may not be able to stay there, but will his heirs get his share? So we have to look at all that when we do estate planning on the families. But it's really important to understand why do we do it? We do the reverse mortgage, how safe it is. I'm not an estate planning attorney, not an insurance agent, but I talk about long-term care down the road because everybody at some point going to need some form of long-term care, just about everybody. And so when you do estate planning, we're seeing a lot of in-family fighting about the heirs. We see situations where they haven't sold a property in 20 years. So it's just something that I think everybody has to understand. And like I said, the property still stays in your name or your revocable trust. And it's like a regular mortgage refinance. We have to do an appraisal. We do a credit check. We do need to document income. But it's to me, it's a product of the future as everybody has refinanced the last 10, 20 years. And now they have a mortgage payment at 80 years old. And so it's something that people got to realize cash flow wise, when you retire, your income's going to be less. When one spouse passes away, the remaining healthy spouse is going to have obviously less income. Would it still be able to make the mortgage payment? Or would she want to take advantage of the equity that's built up? Or they want to help the kids with the wedding or college funding? But I tell everybody, really look at long-term care as a way to fund that. But so yeah, the PowerPoint should be sent out.
Yeah, PowerPoint's in the chat.
Yeah, okay, in the chat.
Yeah.
So when a borrower makes payments back to the loan, do they have a choice of how the payment is applied? It goes to interest and mortgage insurance first, and then the principal. So Leilani, you must have some experience with the reverse mortgage. But yeah, people don't really understand that. It goes to interest and then mortgage insurance first and then to principal. So we have a tax guy here, tax attorney. So when you pass away, because you're not paying the interest, most people, by the way, Leilani, they don't pay the interest. Most people do not. Because of cash flow issues. If the kids want to pay it back, they can. But I tell people, you got to look at long-term care. But so you have no deduction, tax interest deduction while you're alive if you don't make any interest payments. And then when you pass away, you will get, I can't remember the form, Mike, the mortgage interest deduction form, because it's a lump sum of interest that's going to be applied to taxes after they pass away. So that's a good question. But like I said, best to email, text me, or call me. It's not something you can do over the phone, by the way.
Yeah. You want to type in your email address for the chat?
Oh, okay. So I'm gonna give my email. I can't see that. That's the easiest one to get a hold of me. And then my phone number. You can see that.
Oh, GUA.
All right. So Guaranteed Rate is my lender. We're one of the top mortgage lenders in the country. And what we're seeing today is that I've been longer than almost most of the other loan officers in the country. There's a few people longer than me, but this industry has changed so much, especially during the financial crisis. In 2002, when I started, Financial Freedom was the largest company in the country. And then when they sold in 2008, 2009, they went out. And then MetLife Insurance Company with Snoopy got into this business, and I was with them. I was one of the top producers in the country for both companies. And then when the interest rates came down and stayed a long time, low interest rates are not good for life insurance companies. So they eventually got out of business. So I've been with several bankers, the largest in the country, AAG. They had Tom Selleck, the commercial. They were the largest in the country. I was with them, and they shut down as well. And after 2022 crisis, when the rates went up within 2 months, like 2-3%, so did ours, and the volume dropped dramatically. So we had to move companies. Now today in our industry today, we're seeing a lot of regular mortgage companies teaming up with reverse mortgage people. But this industry is very specific, very individualized. It's very, you got to work with somebody that has the experience and knowledge and integrity, because in after the financial crisis up until 2013, we saw a lot of problems, a lot of abuse. Loan officers were causing a lot of problems with how they take the money out. I've seen many situations where they didn't give the documents to the borrowers. They didn't even give their business cards because they don't want the kids to call them. So integrity is a huge issue in our industry, because, as you know, seniors, they believe everything because they expect you to tell the truth, right? There have been many lawsuits in the state of Hawaii. I've been an expert witness in a couple where we're seeing power of attorney used for dementia, and the person that has a power of attorney takes the money. You saw a very big famous case, right, in the newspaper for many years. I could tell that story. But yeah, we're seeing abuses of the power of attorney. And so we try to make sure when they're using a power of attorney that we interview them carefully, we document everything carefully. And if the power of attorney and a successor trustee are two different people, that causes a problem, because one controls this, one controls that. I don't get involved with medical director or post, but those are something down the road you need to start thinking about. So I do another class called The Realities of Aging. If you look in Generations Magazine, I do them 5 times a month somewhere on this island, very small groups, but we kind of identify and detail out things that are going to happen in your life that we need to prepare for. So it's just something that I'm a big believer in. CBB and Mutual of Omaha seem to be popular. CBB is a mortgage broker, so they broker it out to other people. I used to run Mutual of Omaha here, but I'm worried about the low interest rates, and Mutual of Omaha, like MetLife, went out of business. And so I left Mutual of Omaha. I'm with Guaranteed Rate right now. But they're popular. It's not about popularity. It's about, do they know their stuff, and have they been counseled properly? Because a lot of times I tell them, talk to your financial advisor, talk to the kids, talk to their attorney, because we want to make sure everybody's on the same page, everybody knows the plan. Because they're there to sell the product. I'm here trying to explain the whole process, the whole product, and how it benefits you down the road. If it doesn't, I'll tell you first one to tell you. Because a lot of people, they're the salespeople. And it's unfortunate of me to say that, but it's very true. But I like both of them. So it just really depends, Leilani. But yeah, give me a call when you get a chance. Occupancy for condominiums, Daniel. You gotta live once a year. We send you a letter. Do you still live here as your primary residence? No second homes, no rentals. You can travel. We know that you may go to the kid's house or move away for a little while. As long as you sign a document saying this is your principal residence, you're good to go. No, you cannot get any kind of reverse mortgage without counseling. And this is nationwide. So the question about having an attorney, we need to get the copy of the revocable trust, all the pages. If the kids, mom has capacity issues, we look at a successor trustee and a power of attorney. we do need a doctor's letter if we use a power of attorney, stating the incapacity. Well, and sometimes people want to talk to an attorney about it. So I'm going to talk to my attorney and my financial advisor. I said, well, have them call me because most of them do not understand reverse mortgages, especially if you go online and say, oh, talk to your financial advisor. Trust me, I've trained more financial advisors than anybody in Hawaii, and they don't know. And you have to know everything to really give a full consultation. And so I usually come in and I'll sit with the financial advisor and the client saying, this is how it is. That way they know how I work, but also really know the idiosyncrasies of the reverse mortgage. I do a full scope of their life to see how it benefits them and it doesn't benefit for them. Because I'm the one to get the call when something blows up. I said, why don't you call your loan officer? Oh, she's out of business, or they're on the mainland, they don't want to call me back. And so I help them along the way. When you pass away, the last surviving spouse pass away, you're gonna get a letter from the lender when they find out. You get 3 months, 6 months, and if you need more than 6 months, they'll give you 3 months and 3 months up to a year. But you have to put in writing why you're not able to pay off the mortgage. But it can be very adamant about that. As soon as they find out, they must check doctor records or birth records, death records, because I see them as fast as a week to 2 weeks. My brother called me, hey, how did you know my mom passed away? I said, I don't know, but tell them you have some time. So it's a really big problem. They want to get it paid off as well. Are you allowed to rent out the portion of a home as long as you still live there? FHA says you can. So I need to pass it by underwriting. You can't rent out more than 50% of it. So FHA said you can, but a lot of people don't know that. Post-mortgage, can a homeowner make improvements to the property, example, building extension or an ADU? That's a good question. I've never had that experience. And that could be an issue if the lender finds out. Most lenders won't find out at all. And the only kind of an issue is that if there's a legal problem, right? Your real estate law. Mechanics lien, right? They can put a mechanics lien on. So that is a question. That's why we try to talk about the whole life, what's going to happen. That could be an issue. I can't really tell you for now because I've never experienced that. I've never seen that. If your client wants to file bankruptcy and they have a line of credit, take all the money out. Because if you file bankruptcy with a line of credit still available, they're going to lock that line of credit up. It has to meet 2 times, and they never called me. They called the attorney and the CPA, and he said, oh, okay, no problem. No, it gets locked up. It's unfortunate, but any kind of questions, run it by me. If I don't know the answer, I'll get the answer. But these are good questions. Hard to say. Like I said, by these 2 questions, it tells you we don't know how life's going to be. We don't live perfect lives. So, but the reverse mortgage is the most flexible, has more options than any other mortgage versus a line of credit from the bank or a regular mortgage or second mortgage from the bank. Because you can pay it off at any time, you can refinance it at any time, you can sell it at any time, and it gives you a lot of proceeds. Relatively easy to get, relatively. But I still got to qualify income and credit wise. Well, good question there. Daniel Peters, I think I know you. Yeah, counseling is very, very important because, not everybody does a thorough job on counseling. Not everybody does a thorough job presenting the reverse mortgage to their borrowers. They may not have a lot of experience. And I tell people, if you want to use a reverse mortgage guy, deal with somebody that's done over 100 reverse mortgages, or even 50 reverse mortgages, because very few people have. I can count on one hand that I know of. So use somebody that's got a lot of experience. So yeah, you do have to reside there, principal residence. If you go to a care home, make sure that you sign that form because you need to come back. But it's really important to understand life's going to change. You have good people around you. And it's something that do your research. Don't go online because you're only going to read basic stuff. If you have information, call myself or call these 2 other companies here. But if there's no other question, yes, Scott.
Yeah. So how long does the whole process take from, let's say, deciding I want to explore this to when you're able to use the money to pay for this?
Good question. So the question is, how long does the loan process takes? So let's say we meet today. Today is Thursday. So you say, yeah, I'm looking at doing a reverse mortgage. I say, well, you need to call. I can't get involved. You have to call the list of counselors that will give you. Takes about a week to 2 weeks to get set up. Once that's done, I get the form in certificate in writing. I can start the loan process. By then, I should have all your income information, your credit information, and then we start the process. It takes about 30 days. Very fast. From then, at close, they say, we're ready to close the loan tomorrow, Scott. Do you need any proceeds from the line of credit? Yes. Okay, well, then we need to get $5,000, and at closing, you'll get a check after we record to the bureau, and the line of credit will be set up. Like I said, every month you're going to get a statement, and when you want to make a draw, there's a form you fill out, mail it or fax it or email it in, and typically it's 7 to 10 business days. You'll get it wired to your bank account. We did a test in like 2006-07 where we tested getting a checkbook or a debit card. When your line of credit is $200,000-$300,000, that's a scary thought. Somebody could grab that and use that, because once it's gone, it's gone. But we've had lawsuits around town. We've had misinformation spread around town about the reverse mortgage. And so you want a straight answer, just give me a call, text me, and we'll go through that. Money to tax free, yes. So there's no capital gains, right? So when you sell the house, the mortgage has to be paid off, whatever the balance is, and the rest the heirs get. So I deal with a lot of most of my business is from financial advisors. I work with financial advisors a lot. So we're seeing the portfolio. Here's home equity, his portfolio, and slowly the portfolio goes down because they're living life and living longer than they wanted to, or to pay for care, and it's going down. So we're trying to let financial advisors leverage the property, and when a down market, when it's going down, you got to stop that, and then you leverage the home equity line of credit to live. Because a lot of times they're drawing it for long-term care plans, needs, or just living life, right? So the financial advisor been leveraging the property by when he's called me up, say, hey, he's taking out more than he can afford. So we set up the line of credit, so you balance that out. Because once the portfolio is gone, you have nothing left. And a financial advisor loses a client, right? So all we have left is the home equity. I've seen a financial advisor call me up with a borrower went through $1 million in long-term care funds. His portfolio was gone. But he had a $2 million home. But now all we have is the line of credit to pay for his care. He had dementia for 10 years. He's still alive, by the way. Yeah, that's a whole nother conversation with a very experienced, I like to use certified financial planners, CFPs. Otherwise, somebody that understands, I call it financial gerontology. We coined this phrase about 2010. Financial gerontology is from the financial world, you study aging. So you know the risk of aging, the issues that's going to happen. Long-term care, the cost of care is very important. Who do you think reverse mortgage have a sort of a negative perception? For years, even to this day, people think that you take the house. We never take the house. Only time we take the house is if the mortgage balance is above the property value, which does happen once in a while. But I haven't seen that in Hawaii. I think I've only seen one in Hawaii in my 23 years. I'm sure it has happened because, you know, people take all the money out and splurge, and now they're living longer and longer and longer. Now, 20 years later, the mortgage balance doubled, maybe even tripled, depending on how long they live. And because they don't, that's why I never recommend take all the money out unless they need to. I had a situation where the mortgage balance was so high we had to, but they guarantee can stay there for the rest of life. They don't care what happens to the heirs. They don't care what happens to the equity left over. They don't care about what the heirs inherit. They tell them they're not going to inherit anything, which is up to them. But the negative, most of it is misunderstanding, ignorance, having their own thought in their mind about what the reverse mortgage is and not. So that's why a lot of times people call me, because I've been doing it long enough more than anybody else. And I'll tell you the straight truth. I'm not going to beat around the bush. I'm not going to try and sell you anything. It is very important, though, to understand that you can't read it online. It's very, very hard. I've trained CPAs, engineers, architects, and realtors, financial advisors, attorneys, you name it. And they all have their misconceptions, every one of them. So I'm glad the two of you here. I'm glad some 30 or 40 people online. But don't, what I would recommend, the last thing to say, you need to sit down with somebody that has a lot of experience in the reverse mortgage and aging. Because if you're taking them just for funds, you need to understand, you need to plan for long-term care. You really have to. And so what I did several years ago, besides being a certified senior advisor, I have a certified long-term care designation, which very few people have in Hawaii, let alone a CSA designation. But it's just important to understand, I really do care about my clients and how long they live, and they all call me before they pass away. I need long-term care, or how much it's going to cost, da da da. It's a big problem, and it's the biggest thing we're going to face this century, with socially and financially. So think about it, guys. But yeah, give me a call anytime. Text me, email me. More than happy to help you out. If you don't do the reverse mortgage, that's up to you. But and look for my workshops in the Generations magazine. We do them 5 times a year. And put this down, August 2nd. We're doing a big aging in place workshop at the All-in-One Hotel. We'll get probably close to 2,000 people there. We have 6 workshops going on at one time. And we will have a financial advisor there. We will have an attorney there. We will have a geriatrician there. We will have a neurologist there. I will be there. We will have people talk about long-term care, talk about caregiving, healthy aging, all the gamuts of aging. So August 2nd, look in the Generations magazine, and you'll see the big spreadsheet. It's coming out in, this is June. July issue will come out, the spreadsheet of all of them. If not, I have the copy right now. If you want me to email it to you or text it to you, I can do it as well. But thank you very much, everybody. Take care of your clients. And my saying is live well. Thank you.
Thanks, Percy.
Thank you.
Email. What's your email?
Percy E. Howard at Hotmail.